Imagine, for a moment, the sheer paralyzing shock of watching a physical asset, a commodity revered across civilizations for thousands of years, sustain a colossal price collapse. We are not discussing a volatile, unproven cryptocurrency or a highly speculative biotech stock with zero revenue. We are talking about silver. And the collapse was not gradual. It was a brutal, systematic event that wiped 22% off its market value. Gone. Evaporated. In a mere 2 hours. 120 minutes of sheer financial terror that left veteran traders and analysts stammering, searching for an explanation that transcended the standard textbook theories of profit-taking or technical selling. This was a market event so extraordinary, so rapid, and so perfectly executed that it immediately smelled of something far more sinister than organic market forces. It was a moment of absolute financial violence, a targeted strike designed not just to correct the price, but to utterly crush the bullish sentiment that had been carefully building momentum across the preceding months. The question that rattled the foundations of the precious metals community was not if this was manipulation, but how such a massive rapid suppression could possibly be achieved without direct intervention from governmental regulatory bodies. To truly grasp the magnitude of this event, we must contextualize the landscape immediately preceding the drop. Silver was riding a wave of fundamental strength. Global inflationary pressures were undeniably increasing, fueled by unprecedented quantitative easing programs worldwide. Silver was being widely recognized as the perfect inflationary hedge, often referred to as poor man's gold, but with the added bullish layer of crucial industrial demand, particularly in solar technology and electric vehicle production. The narrative was strong, the physical premiums were rising, and retail interest had soared, creating significant long positioning among speculators and the broader investing public. The market felt tight, coiled, and ready for its next explosive move higher. Then, at a highly strategic time, when trading liquidity was thin and volatility tends to spike, that critical crossover period between the late European session and the early North American session, the selling began. And it wasn't just selling, it was an avalanche of sell orders delivered with staggering velocity into the futures market, specifically the COMEX. The technical term is a waterfall event, but that phrase hardly captures the sensation of watching every support level, psychological, technical, and algorithmic, crumble instantly. Stop-loss orders, clustered precisely beneath what were perceived as safe support zones, were triggered in sequence, forcing unwilling sellers into the fray. This created a powerful feedback loop. Price drops, margin calls are issued, forced liquidation occurs, price drops further. It was a perfectly orchestrated mechanism of destruction. This velocity is the key indicator of non-organic activity. Normal market selling, even heavy profit-taking, distributes itself over hours, allowing time for new buyers to step in and absorb the selling pressure. A 22% move in 120 minutes, however, requires the commitment of astronomical paper capital, specifically focused on overwhelming the margin requirements of leveraged long contracts. It requires a player, or a consortium of players, that is unfazed by short-term losses because their long-term position, or their overriding objective, is to maintain the illusion of supply abundance and price control. For those of us tracking the mechanics of precious metals pricing, this type of ambush inevitably points toward one arena: the paper market, dominated by the heavily leveraged futures contracts traded on exchanges like the COMEX. This is the financial battleground where the actual price of silver is determined, largely disconnected from the physical inventories held in vaults. The entire structure is fundamentally built on leverage, and leverage is a double-edged sword. When the price moves against you, the mechanism of margin calls forces the hand of the speculator, turning bullish enthusiasm into panicked fire sales. We must understand the primary antagonists in this structural setup: the commercials. These are typically the large bullion banks and financial institutions that utilize the futures market ostensibly for hedging purposes, though their consistent behavior suggests a strong tendency toward aggressive, concentrated short positions. These entities often hold massive, entrenched short interests in silver, viewing the ability to suppress the price as essential to their continued operations and profit margins. Before we delve into the forensic analysis provided by the renowned expert who witnessed this crisis firsthand and has consistently challenged the legitimacy of the paper pricing mechanism, Eric Sprott, let's take a moment to ensure you are fully engaged with this vital market investigation. If you find this detailed behind-the-scenes breakdown of financial mechanics useful, please take one brief moment right now. Smash that like button. Your engagement is the critical signal that pushes this crucial, often suppressed analysis out to a broader audience. And if you have yet to join our community, subscribe to the channel and activate your notification bell. We depend on your support to continue bringing you this level of deep-dive market scrutiny. The event of the 22% drop was fundamentally a short squeeze turned inside out. The retail investment community, the small speculators, and even some mid-tier funds were long. They believed in the physical fundamentals. The commercials, however, were overwhelmingly short. They had accumulated staggering short positions, essentially betting that the price must fall. The attack was launched precisely to exploit the vulnerability inherent in the leveraged long position. By deploying massive sell orders, synthetic supply flooding the market, they triggered the cascading liquidation of the long side. This wasn't selling because the banks thought silver was fundamentally worthless. This was selling because they needed to protect their existing short bets by forcing the price down to an acceptable level, thus avoiding a potential short squeeze that could have bankrupted their positions. This is the exact point where Eric Sprott enters the narrative. Sprott, a legendary figure in the natural resource and precious metals sector, views the world through the lens of physical reality and monetary discipline. He is not just an observer, he is an institutional buyer of physical metals, running trusts that hold enormous quantities of allocated silver. When he speaks, he is speaking as someone whose business model is directly challenged by synthetic price manipulation. Sprott's explanation cuts through the noise of conventional media reporting, which often defaulted to generic excuses like dollar strength or risk-off trading. He argued, vehemently and immediately, that the cause was simple, devastating, and entirely premeditated. The strategic deployment of paper shorts by the established powers to neutralize the retail, fundamental buying pressure. His analysis focused on the behavior of the commercials in the days leading up to the crash. He noted a highly suspicious and unusual surge in the net short position held by these large banks, indicating a concerted effort to prepare the necessary weaponry for this price attack. They weren't just hedging, they were loading the figurative financial cannon. The complexity lies not just in who sold, but in where the paper came from. Sprott's fundamental claim is that the amount of silver sold in those 2 hours far exceeded the available physical inventory that could possibly be moved that quickly. This confirms that the selling pressure was synthetic, pure paper, created out of thin air, designed only to manage the futures price. The 22% drop was, in his view, a stunning, brutal display of financial power, intended to signal to the market that the long side would be punished severely for daring to challenge the established price ceiling. We have established the crime scene, a massive, unnatural drop in silver, perfectly timed, utilizing the hyper-leverage of the COMEX futures market. We have identified the mechanism of destruction, cascading margin calls, forcing liquidation of the vulnerable long positions. And we have pointed to the prime suspects, the commercials and their immense preloaded short positions. But the full scope of Eric Sprott's explanation, his direct naming of the entities he believes are responsible, and the long-term implications for investors who rely on silver as a store of value, requires a deeper dive into the regulatory failures and the specific recommendations he offered to mitigate future raids. What happens next is crucial, as Sprott not only diagnoses the illness but offers a prescription for immunity. The details of his ultimate conclusion and his advice on shifting investment strategies to counter this persistent pattern of price suppression are too critical to summarize hastily. We have now laid the essential groundwork for understanding the structure of the attack. In our continuation, we will dissect the specific institutions Eric Sprott points his finger at, analyze his detailed evidence proving premeditation, and, most importantly, explore his practical advice for every single precious metals investor, seeking protection against this weaponized financial volatility. Do not miss the explosive conclusion where we reveal Sprott's ultimate forecast for silver's true value and the future of market integrity. Ensure you are fully subscribed and that your notification bell is activated so you are instantly notified when that critical Part 2 analysis is released. The question we must ask ourselves after reviewing the sheer mechanical impossibility of the drop is this: what could trigger a selling event of such catastrophic, concentrated magnitude without any corresponding global news event, economic crisis, or shift in industrial demand? The initial theories, while emotionally satisfying, the idea that it was some rogue algorithm or a massive margin call cascade among smaller players, simply do not hold up when you look at the quantity of paper required to push the price down 22% in less than 120 minutes. Remember, a sudden drop of this nature, especially in a relatively thin market like silver during Asian hours, requires an overwhelming one-sided push. Sprott's deep dive analysis, the one that really captures the essence of the manipulation, focuses on the structural reality of the market, not just the symptom. He argues definitively that this was not a matter of physical supply and demand finding a new equilibrium. This was a surgical strike executed by those who control the derivative infrastructure, namely, the mega bullion banks who perpetually maintain the massive short positions on the COMEX. If you are finding this explanation of market structure compelling, please take a second right now to smash that like button. It tells the algorithm that this vital information about market manipulation needs to be seen by more people. Let's contextualize the sheer violence of that 2-hour period. To drive down the price of silver by 22% using only physical silver would require offloading what amounts to several months of global mine production. The physical market simply cannot absorb or liquidate that volume in a matter of minutes. The only way to generate that effect is through the unlimited creation of paper silver, unallocated futures contracts that promise delivery but rarely, if ever, represent actual metal waiting in a vault. This brings us directly to the engine room of the manipulation, the COMEX futures market. Sprott and his team concluded that the selling was executed by dumping an extraordinary volume of contracts, likely equivalent to hundreds of millions of physical ounces, all within that compressed time frame. The goal was twofold. First, to trigger the cascading stop-loss orders placed by retail investors and momentum traders who had recently entered the market based on silver's initial upward momentum. Second, and more importantly, it was a strategic move to relieve the pressure building against the large, concentrated short positions held by the major banks, the infamous Big Eight, who control the majority of the short side of the futures market. Imagine being one of these massive bullion banks. You are short silver, meaning you profit when the price falls. But silver has been steadily rising, putting pressure on your short position and increasing your liability. You know that if silver breaks certain technical resistance levels, a huge influx of institutional money could come in, triggering a monumental short squeeze that could bankrupt you. What is your solution? You use your massive trading power, often coordinated during the most illiquid time of the day, the early morning hours before London and New York are fully operational, to flood the market with sell orders, regardless of price. This is not trading. This is weaponization of market structure. This is where the story deepens into a regulatory critique. The banks are allowed to maintain these enormous, concentrated short positions precisely because regulators like the CFTC, Commodity Futures Trading Commission, have historically chosen to look the other way, classifying these positions as bona fide hedges. However, Eric Sprott's decades of analysis suggest these are not hedges protecting a legitimate physical position. They are speculative, price-suppressing instruments designed to keep the lid on silver prices to protect the stability of the dollar and the existing financial system. The sheer audacity of the move in August 2020, when this incident occurred, was meant to send a clear message. We control the price, regardless of physical reality. But the most telling evidence that this was a paper attack comes from looking at the COMEX vault statistics, a metric Sprott meticulously tracks. The COMEX inventory is divided into two categories: registered and eligible. Eligible silver is silver held in the vault that meets COMEX standards but is owned by a client, it is eligible to be delivered. Registered silver is silver designated by the owner for immediate delivery against a futures contract. This is the silver the market really relies upon for settlement. If a crash of 22% were caused by a genuine glut of physical metal, meaning supply overwhelmingly exceeded demand, you would expect the premiums for physical products, like silver eagles or maples, to drop dramatically, and the registered inventory at the COMEX would be overflowing. But the opposite happened. During and immediately after the crash, the premiums for actual tangible silver bars and coins, what the retail public buys, barely budged, and in some cases, they actually increased. This is the ultimate pattern interrupt. If the spot price, the paper price, collapses, but the price you pay for the physical product remains high or goes higher, it proves the paper market has completely decoupled from the physical market. The paper price was crashing, but the physical reality was still one of scarcity and strong demand. If you are learning something crucial about how the market actually works versus how it is reported, please hit that subscribe button right now. We need to build a community dedicated to financial truth. The implication is staggering. The banks were willing to sell contracts at artificially low prices, losing money on the paper trade temporarily, specifically to prevent the real pain, the catastrophic short squeeze that would have occurred if silver had broken out. They used this coordinated paper drop as a preemptive strike, a form of financial intimidation designed to ensure that the weak hands, the retail traders, would panic sell their leveraged positions. Sprott's analysis doesn't stop at identifying the mechanism. It identifies the intent, liquidation, and fear. The banks allowed themselves to cover some of their dangerously massive short positions cheaply, capitalizing on the chaos they created. They bought back contracts from panic sellers at the bottom of that 2-hour plunge, significantly reducing their future risk exposure, all while cementing the perception that silver is too volatile and too dangerous for mainstream investment. This brings us to the ultimate conclusion and the payoff for understanding this detailed market structure. The 22% drop was the clearest possible evidence that the silver market is fundamentally broken, artificially suppressed, and structurally manipulated by the very institutions entrusted with its operation. The manipulation serves a purpose that goes beyond simple profit for the banks. Silver has always been the monetary metal of the masses, often seen as the canary in the coal mine for systemic instability. By aggressively suppressing the silver price, central authority attempts to suppress the signal of inflation and the inherent weakness of fiat currency. If silver were allowed to trade freely based on its diminishing supply, driven by solar, industrial, and electrical demand, and increasing investment demand, its price would likely be significantly higher, raising alarm bells about the devaluation of the dollar. The paper manipulation is, therefore, a necessity for maintaining confidence in the current financial regime. Sprott's final powerful summation of the event is a warning and a guiding light. The price suppression cannot and will not last forever. Every time a crash like this occurs, the physical reality only becomes more entrenched. The discrepancy between the paper price and the physical price widens. The amount of registered silver at the COMEX continues its long-term decline, forcing the banks to use ever more extreme and violent paper maneuvers to maintain control. They are fighting a rearguard action. The key takeaway for any investor is that the August 2020 crash was a massive head fake. It was designed to shake out the retail public, but for those who understand the physical reality, the dwindling supply, the rising industrial uses, and the fact that 80% of newly mined silver is immediately consumed, it was an extraordinary buying opportunity. The market's reaction proved that the paper price is a lie, and every time the lie is pushed this hard, the eventual snapback toward the true physical value will be that much more violent. This manipulation, explained by Sprott, should not breed fear, but confidence. It shows that the forces trying to stop the rise in precious metals are desperate and must resort to increasingly obvious and heavy-handed tactics. If you want to ensure you don't miss our next deep dive into the opaque world of commodities and market manipulation, make sure you not only subscribe but also hit the notification bell. Share this video with anyone you know who holds silver or is considering investing. Understanding the true cause of that 22% drop in 2 hours is the key to understanding why silver remains perhaps the most undervalued and heavily controlled asset on the planet today. Don't be fooled by the paper price. Focus on the dwindling physical supply. That is where the real power and the inevitable payoff lies. Tell me in the comments below, after hearing Sprott's explanation, do you believe the manipulation is coming to an end? Or will the banks double down? I read every single comment.